Hey, this is Warren Redlick. Thank you for watching. I'm here with Xander. I know Xander from Clubhouse, and we talk a lot about Tesla stock. And Xander in particular is one of a group of people who are very interested in buying and selling, or well, he'll tell you more about this in a second, in trading in options on Tesla stock and maybe other stocks, I'm not sure. And I feel this is a very complex subject, and I have strong opinions. I'm not a fan of the strategy, but I enjoy the conversation about how it works. And we'll hear Xander's take on it. I'll point out what I think are the flaws, and we'll see how it goes. Xander, my understanding, you're not some Wall Street guy. You didn't learn about this in an MBA program. How did you get involved in trading options?
I learned from, first of all, thank you for having me, Warren. It's a pleasure to be here. I love talking to you on Clubhouse. And I just learned from YouTube. I watched a person like Emmett Peppers on Dave Lee's channel. And when I learned that he took his Roth from 2,000 to something like 30 million, the first question I had was how, right? So how is it possible that you can scale like that in a short time frame? So that's how I got interested. And then I just watched a bunch of YouTube videos and taught myself how to trade options. There was a person on Clubhouse, shout out to Ronnie, and he, I made a statement when I was buying my, making the decision to buy my wife's Model X. And I said that, oh, well, if anything, I would sell some stock. And I already was learning about options and buying calls or buying puts, but I never sold. And so once I spoke with him and understood exactly the mechanics of it, I sold my first put, which is you're basically making a contract to purchase shares at a certain price. So if the strike price is below.
You're talking about selling puts. So when you sell a put, somebody pays you money and you're agreeing to do something if something happens. So
Correct.
What has to happen, and then what do you do when it happens?
So you would sell a put. You're buying. Someone's giving you money, like you said. Sorry, someone's giving you money, and you are agreeing to purchase shares at a predetermined level. So if the price falls below that level, it doesn't matter. You already made a deal to sell it at a particular level.
Okay,
so,
just to be clear here, I sell a put to
correct.
where I'm agreeing to buy Tesla stock at $800 if it falls to $800 a share.
Correct.
Okay.
Within a certain time frame.
At a certain date. And
yes.
there's a strike date, which is the date we're agreeing that this is going to happen, and there's a certain strike price, which in this case might be $800 a share. And somebody maybe pays me, and it's a put. When you sell a put, you're effectively selling. I think you're going to buy 100 of these. You're agreeing to buy 100 shares. So
one contract is the equivalent of 100 shares. Correct.
So buying 100 shares of Tesla at 800 would cost you $80,000 in cash.
Correct.
Okay, and so
it would be 80,000. Correct.
And so somebody pays you, let's say, $2 an option, which works out to $200.
Correct.
And you're agreeing to buy the stock you get $200 and you're agreeing to spend $80,000 buying the stock. If on that date the stock is basically, if the stock price is above 800, it doesn't happen, right?
Yes. So the tricky part is that you need to have a buying power in your brokerage of $80,000, right? The brokerage would be willing to loan you money at that time. So you're not really taking out a loan. You just show that, hey, I have the capital standing to do this. And this is why the stock split is such a big deal, because you will be able to now, like, let's say we have a 10 to 1.
Well, hang on, don't get into the stock split yet, because
okay.
But we'll deal with the stock split in a minute. So right now we're talking about selling puts, and selling put is I'm agreeing to buy the stock on this date for this price. And if the stock is trading above that, and I'm buying it from the person who I sold the put to.
Yeah, person or institution.
So that person is not going to want to sell it, is not going to exercise their option if the stock is trading below the strike price. They
Well,
don't
they
want to
will.
sell their stock to you.
Well, so
I'm sorry, if the
yes,
stock is trading above the strike price,
they
they
don't
don't want
have
to
to.
they don't want to
Yes,
sell to you for $800 if the stock is trading at 900. It's just
correct.
they're insuring themselves. If the stock falls to 700, they can now sell the stock to you for 800, and they're making, $10,000 effectively, compared to what the stock is worth on that date to what you're paying them for it.
Yes, you're on the right track. I think we're getting a little confused between who's who, but yes, the person who sold the put is collecting a premium, and they get to keep that premium or money if the strike price never gets reached. So if we stay above $800, and let's say we sold a 1 week out or 2 week or month or whatever you choose, obviously the further out you sell, the longer of insurance that you're providing, and that's what this mentality is like. You're selling insurance.
Just to be clear for the viewers, the way options work is there's a strike date, and it could be next week, it could be 2 years from now. There are some options
Correct.
that stretch out as long as 2 years, and there's this complex world of pricing, how much the options are cost, or how much you get paid for selling a put, or how much I got to pay to buy a put. And there's also calls. Let's just talk about calls really quickly.
Sure.
I can sell a call, and selling a call is I have 100 shares of Tesla stock, and I sell a call at say $2,000 a share. And what I'm agreeing to do is and let's say it's a year from now, okay, on the strike date, a year from now, if the stock is trading above $2,000 a share, the person who paid me for the option is going to buy the stock, and I have to sell them at $2,000 a share, even if it's trading at $2,500 a share at that point.
Correct.
Okay, so
that's selling a call.
All right, so there's there, and the person who's buying the call is paying me money so he can
Right.
buy the stock at that price in the future.
So that they have the option to buy the stock at that price.
And they would not exercise the option if the stock was trading below 2,000, because then they'd be paying over market for the stock. Person who buys a put option is not typically going to exercise the put option.
Exactly.
And
they can't. Yeah.
Well, if the stock is trading below their strike price, if
Correct.
they have the right to sell you the stock for $800 a share, and the stock is trading at $900 a share, they don't want us. They could sell it for $900 a share. Why would they sell it to you for $800? So
right.
it's
exactly.
only
so
it
makes the contract worthless at that point.
Right. And so the game is, if you do this right from your perspective of selling puts, if you get paid $200 and you believe the stock's not going to be below that price on that date, you're just getting $200. Right?
Exactly.
The other person is insuring themselves against the risk the stock does fall below $800 a share.
Right. So when I sell it, on the put side, I will ensure that I'm willing to buy it, right? And for them, as the person who's purchasing the put, they're willing to sell it. So
okay, so
if that makes sense.
Right. So, and the theory is, if you do this right and everything works out great, people just keep paying you for puts, and you
Right.
never have to sell a share. You never have to buy any shares. And
Exactly.
you're just making money every week. You make another $200 or $2,000 or whatever it is.
Right. As long as you don't get too greedy.
Right. And then if you're not careful, if things don't work right, if something goes wrong, all of a sudden you might have a problem.
Yes, and there's two types. So one is you might take assignment of the shares, but that might be a good deal, right? You're happy to perhaps expand your position at that price, but you can also do things like, it's called rolling it, and you just move up. So you buy to close that contract, and you open another position to sell to open at a higher strike price.
What does it mean?
Does that make sense?
What does it mean buy to close the contract?
So when I sell to open a contract, right? For me, as the seller of this put, I'm selling a contract and it's opening a position. And if I were to do the opposite of that, that would be sell. It would be buy to close.
Well, is that when you buy to close? Does that mean you contact the holder of the option and say, I want to close this out, I'll pay you this much to close it out, or is it just a traded option that's out there and there's somebody else?
Exactly.
Okay.
There's a counterparty, but it's not like it's an individual that you're interfacing with. You just do this with clicks on your brokerage
right, but
screen.
The person you then close the position with, they're actually taking on the put that they're going to have to sell it later. They're going to have to sell the
Perhaps.
stock. They're going to have to buy the stock later if well, no, when you created this option, right? You sold somebody a put.
Yes, there's a middleman. So you got to think about market makers and the inner workings of Wall Street is a whole nother deep dive. We saw that with GameStop, and understanding how that works is a whole nother level. I don't think we should get into. But there's a counterparty, right? There's a middleman that will transact on our behalf, right? They will make sure to have stock ready to sell to one side, and then I'm just making a commitment to sell stock. I don't know where it goes.
Okay, what are the transactions costs when you do an options trade? When you sell a put at, let's say, strike price of $800 a share for 2 weeks from now,
Yeah.
What do you pay? Is there a commission that you pay? Who gets the money? Where does that go?
Right. So the brokerage collects the money, and my contracts are 65 cents per contract. So it's negligible. Now with a split,
65 cents on a contract where you might be paying $80,000 for stock.
Correct. But
Okay.
if you're collecting, let's say you're collecting in a safe manner, $500 to $700 per week is kind of my target. And obviously, as things are more volatile, you may get more, you may get less on either side, either the put side or the call side. But if you're doing it safely, you're 65 cents on a $500 would be a more reasonable way to look at it.
Okay. So it's way less than 1% transaction cost.
Way less, correct. It's negligible.
And there's no other, I think you also have to have margin available on your account.
So, yes,
is there a cost in your brokerage to have margin trading?
No. And in fact, you should contact your brokerage. You do need to enable options, and you do need to, I recommend calling them up and negotiating the rate. They're usually in the sixes or whatnot, but you can get them down. When I got them down to below 2%. And obviously that makes borrowing on margin, if you actually take assignment of shares, more affordable. But again, with this strategy, you're not really going into margin. You're just saying that you have that available.
So in other words, if you were forced to go, if the option went bad, or not bad, if you ended up having to go through with the transaction and you have to buy $80,000 worth of stock, you would borrow on margin against the stock that you already have, and you would pay 1 or 2% rate of interest on that margin borrowing until you figured out how to close out the.
Exactly. And there's something called a cash secured put. So in my case, I sold my house, and for a little while, I was just keeping the money in the brokerage, and you get a larger buying power having cash in the bank, right? Having cash in the brokerage. And there's a thing called the wheel strategy. That's you sell these puts until you get a sign, right? And then you you buy a call on the opposite side. You sell a call on the opposite side, so that you end up having to sell those 100 shares that you took on at a lower rate, and you just keep doing that over and over. And that I recommend a channel called In the Money. Very, very good breakdowns in simple terms. So that's one of the channels that I learned from.
When you started describing how you got into this, you mentioned Emmett Peppers, and I am also a fan of Emmett Peppers, by the way. And you described how he started with $2,000 and ended up with $30 million. And one of the things that concerns me when people talk about options is it's a little bit like going to the casino. The winners brag about how much they won. The losers are quiet. And it gives people who are outside of this potentially a distorted picture of what actually happens. I think very few people play the options game and go from $2,000 to 30 million in 2 years.
Absolutely. That is correct.
And we don't know, and we don't know how many people play the options game and actually end up losing money.
Right. And stay quiet and they're not public.
And it's I don't know if maybe you don't agree with me on this. I think it's a zero-sum game. So if Emmett Peppers made $30 million, collectively, someone else lost $30 million.
You used the right word, collectively, but it's not as cut and dry as that. So you have obviously it's risk, but the average Tesla investor, right? I talk to them all the time on Clubhouse. They're just hodlers and they don't do anything.
Hodlers means holding long term. Yeah.
Correct, holding on for dear life. Yeah, that's the acronym. So so they just hold it, and that's a great strategy, right? Dollar cost averaging. All of these are great strategies. The point and the reason I got into selling, right, is don't be the gambler in the casino, be the casino. So it is a much safer strategy if you can maintain your discipline to not get too greedy, right? Those premiums, the closer you are to the current price, the higher the premium you can collect, and that is very, very tempting. So I'm happy to share specific examples where I had to roll forward to when the stock price dropped because I was being very greedy, and it means that I can't sell puts on that money for a certain amount of time. So you know, in my specific case, I have 3 contracts that are pushed all the way out to January. Actually, this morning I was looking to see what I could do since the stock price has moved a lot and it's trending upwards. So there are ways to not pull money out of your pocket to kick the can down the road, so to speak. And but the losses can mount up if you panic sell, just like with stock. You can lock in a whole bunch of losses, and now you do owe the brokerage unless you have cash sitting in your brokerage. So if that makes sense.
Well, my concern is just like the casino. People see the stories, you know, you see the story of some guy who won a lot of money, and some people might think, well, I'll go to the casino and I'll make a lot of money. And you don't, because the way the stories, because like if I win, I'm excited and I tell people. If I lose, I'm depressed and I don't tell anybody.
Right.
There's a net effect there that people get the false impression that it's easy to
Yes.
win money, and they don't see the losses. And the same thing in options trading. I keep hearing people talking about options, and you hear an Emmett Pepper story. The people who lose playing options don't talk about it. And
Yeah.
the average person who's thinking they're going to get into this might have people should understand it. Here's my take. Okay. People should understand it's largely a zero-sum game. It's not quite a zero-sum game. It's close to a zero-sum game. If you win, somebody else is losing. If somebody else is winning, that might mean you're losing. And on average, you would expect 50% of the time you're going to win and 50% of the time you're going to lose, or maybe 90% of the time you're going to win small and 10% of the time you're going to lose big. And it's all roughly going to even out. You add in transactions costs and you add in the value of the time you spend doing this, and in net, you may be losing money. Tell me why I'm wrong.
Yeah. So there's so many things as you're speaking that come to mind, but let me give a little background. I come from the classic investor of an index fund. I don't come from money. First generation immigrant, and I never bought an individual stock prior to Tesla. And in 2019, when I saw the tweet, the 420 tweet, and the stock get cut in half, I bought my first 5 shares. So the people that are perhaps paying attention and are the Tesla investors, they're not the type that are too gambly with money. They're not trying to make it rich, right? Get rich quick. They are trying to learn something about this other aspect of trading, which is derivatives. So when you have 1,000 shares of Tesla, right, and you've had the stock split, you're an earlier investor, and now you have all of this stock just sitting there doing nothing. Well, there is a way to make it work for you. Now, I'm not talking about like Emmett Pepper's buying the options and making a play, right, on, let's say, a stock split or a S&P inclusion. I'm talking about just putting your portfolio to work. And that, you're not wrong. Those are all important things to consider, but I think that that's what's said. It's a zero-sum game. Don't do it. You don't know what you're doing. It's for the big boys. all of those statements were things that I had to combat, and internally and with family. So to, everyone, my friends, they thought I was crazy for doing all of this stuff, but I continued to research and then just experiment, right? Paper trading is something I recommend, right? And what that means is that in your brokerage, you're making those trades, but you're not actually putting your money at risk. It's just digital dawdlers, and they're not real.
Well, let's just say one of the things that I find interesting is when you're selling puts, you're agreeing to spend money to buy stock. If you're selling calls, you're agreeing to sell your stock and receive money. So in a sense, is selling calls less risky than selling puts from a cash perspective?
Yes, it's selling out at a high feels good. There could be tax implications depending on your portfolio, but that is easier because the stock is going up.
Well, you're not going to get margin calls if you're selling calls.
Exactly. That is
you just
correct.
have to sell stock that you already have. If you sold,
correct.
If you
now,
what is it called, a naked call or something like that? If you sold a call for stock you didn't own, that could be a problem. But you're not playing with naked. In other words, a naked call would be like a naked put would be if the person you're selling the put to doesn't actually have the stock, and they're committing
correct.
to buy the stock and then sell it to you if it happens. A naked call would be you're agreeing to sell stock you don't own, and you would have to buy the stock at that point in order to sell it. But you're not playing naked calls or naked puts.
Honestly, one half of a contract. So instead of the number of contracts that I could sell on the call side, I sold slightly higher because at that time I can, one contract higher because at that time I can go out and buy the stock if I needed to, if that were the case. But I'm very conservative on either side. The call side doesn't pay that much. So, there's an expression like getting in front of the steamroller, picking up pennies in front of it. That's not a great idea because Tesla is going to run and they're going to run big. But there is a little bit of premium, if you can be safe. If like for this, as an example, for this Friday, if you were to tell me that we're going to run to 1250, in my mind, I think that there's going to be, a hesitation at 1200, which is the prior all-time high. So can we get there? Yes, it's possible.
But if I sold a call for next week to sell that worth a strike price of $1,500 a share, it's unlikely the stock is going to go that high. So somebody's not going to be willing to pay me that much for selling that call.
Correct. And we can get into a specific example if you'd like. It wouldn't take like 30 seconds.
Yeah. Well, and then then there's a complexity to this. I think you feel it's simple now because you've been doing it for a while, but how much time did you spend learning how to do this? And how much time do you spend in a typical week doing it now?
Yeah, I spent, before I got the confidence to actually sell my first option or even buy my first option, I researched for about a year, specifically on options. But really it was that December of 2020 that I believe the inclusion happened. I could be off on the year. With COVID, everything flew by. But then when Emmett did that inclusion trade, I wasn't confident enough to follow him. And I think that that's an important thing. You have to be honest with yourself, right? Like I keep spreadsheets and analyze my performance. I don't lie to myself. So from that time in December till when GameStop happened, I bought my first option, and I believe it was like February. So that really is the concentrated time. It was about 3 months of just full on understand what you're doing before you make the decision to either buy or sell calls or puts.
Okay.
And the difference with the derivatives.
3 months, did you spend 20 hours a week in those 3 months learning this? Was it 10 hours a week? I'm just trying to get a sense of how much total time, how many hours, because here's the thing. There's an opportunity cost to a person's time. If you spend time doing this and instead you could have gone out and worked a $20 an hour a week job and you put 1,000 hours into something, you could have made $20,000 at the job and then invested that $20,000 in Tesla stock. And just to be clear, my strategy from the beginning has been buy Tesla stock and hold it. I'm a hodler. I don't think hodl comes from hold on for dear life. I think hodl actually comes from someone actually misspelled HOLD in a prominent moment. And then people interpreted it as hold on for dear life, when really it was just somebody misspelled hold as hodl. You think I got that
Not,
wrong?
I believe so. I believe so. I thought the same thing initially, and then upon research, it makes sense. It's a hodler. That's why it's not a holder, right? It's a
Mhm.
person who's holding on, and they won't, diamond hands, baby, right? They
Right. No,
won't let
and
go.
and just to full disclosure, I own a lot of Tesla stock. I started buying in 2016. I think February
Congratulations.
2016 was the first time. It was probably motivated by SpaceX landing the first orbital rocket booster, and I just realized, okay, if they can do that, because it's Elon's company also,
Yeah.
and I hark back to that, by the way, when people say the competition is coming for Tesla. I'm like, well, when's somebody else going to land an orbital rocket booster? It's been
Right.
6 years. Is it 7 years? We're in this. It's been more than 6 years since SpaceX landed its first orbital rocket booster, and no one else has even tried yet. So Tesla's developing certain things, and other people are sort of coming along. But I think you'd probably agree with me that nobody's really made a better EV than the 2013 Model S. They're getting a little closer to the 2013 Model S. They're nowhere close to the 2018 Model 3.
Yeah, and I put my money where my mouth is, right?
Yeah,
I sold my houses and I'm renting now. So
yeah.
I believe in it strongly. I think it's going to be the biggest, company by market cap
Yeah,
very
we both
soon.
think Tesla's going to $10 trillion or more in the long run at
Yes,
market
yes,
cap.
and I'm not like just a person that just thinks that I'm evaluating, right? So I'm doing discounted cash flows. I'm listening to a lot of the YouTubers that are more reasonable, and not just it's going to the moon, and so there's opportunities to
That would be me, by the way. I'm the to the moon guy.
so well, it will eventually, but there's a lot of zigzagging that's occurring in between, and that's the opportunity, right? That's where if you can get beyond just the standard, to answer your time question is, I put a lot of time into it. I'm an obsessive type. I'm analyzing, I'm a business owner, so numbers is my thing. And there's James Stevenson, right? Like
Yes.
these people that are going in and going through it with a fine-tooth comb and setting reasonable expectations besides just pumping the stock. That gave me conviction.
Okay.
I think it's important to analyze what you're willing to commit to. In my scenario, my business opens at 11 and noon. That's the frozen yogurt business, so I have plenty of time, right? The market opens at 6:30. I'm on the West Coast. So for me, it's just the hardest part is balancing family and work. Selling a put is a few minutes of contemplation of what strike price you want to commit to, and then it's a click, right? And so the big thing is that with all of this, it's front loaded, so it's not zero sum. It's not that you're always spending a lot of time. It's educate yourself, understand how the mechanics about it works, and then just do some paper trading to see that you understand it correctly. But obviously, not financial advice.
So
It has risks.
let me ask you this. How many trades do you do in, let's say, a week?
A lot. So
Well,
in
more than
addition,
100?
no, not more than 100, but as I'm getting more and more a bigger handle on my business, I've been actually uh, day trading those put contracts or day trading the call contract. So sometimes when like on a day like yesterday, I was actually live trading on Clubhouse. I sold a put at 10:35, and as we're running up, so I bought it in, I sold it in the morning, and then later on in the day I closed out that position, went at the top of a wave, is how I describe it. And then when the stock kind of recovers and starts falling, I reopen that same exact position. So I'm basically like skimming, but if I'm wrong, meaning the price keeps falling, I pick the floor to where I don't think it's going to get to, and what I'm willing to pay. and the way you want to think about it, it's like a balloon that's deflating. And the more time once you sold this, the more time you're holding on to this contract, the value of that contract is deflating because I'm selling it for this Friday. And so I do that. I get in and out. Yesterday, I also bought a call for this morning, which is looking good. Not expecting to get rich. It cost me $3,000 to do it at the end of the day. If it goes, to 4,000, that's great. If I'm wrong and it drops to 2,000, and I feel that it's time to close that position, I get out. Right. I'm not looking to like one shot get everything.
Well, let's go with this. The point I was trying to get at was this: we were talking earlier that the commissions aren't that much because it's only 65 cents. But if someone did 100 trades a week,
yeah,
at 65 cents, it would be $65 a week that someone's spending on commissions.
Sure, but if you're doing it right and you're willing to make that many trades,
I'm just saying this is a cost. You add that up. Let's say it's $50 a week, and you have 50 weeks a year. You're spending $2,500 on commissions. This is the point I'm trying to make is that a lot of, and I'm not pitting this on you, I just feel like the culture of the options community minimizes the transactions cost by saying, oh, it's only 65 cents a trade, not recognizing if somebody makes a lot of trades, they may be spending $2,500 a year in commissions, and that's a cost that comes out. And again, if the trades themselves are effectively a zero-sum game, okay, then collectively, all the people doing the trades are losing money because they're spending money on commissions, and the trades work out even in the long run on the options.
So it just depends how you look at things, right? Like I think the example of what we discussed earlier, that you're collecting a $500 premium and it's costing you 65 cents to have that option to collect that, right? It's negligent.
But somebody else paid the $500 premium. So in net, the two of you broke even, except you paid $1.30 between you in commissions.
Well, it's insurance, right? So even though I collected 500, the other counterparty would actually get a benefit, right? It's more than just what they paid. They because the stock price is much lower. But again, I don't think about any of these things. They're not the point of doing this. So if you have a giant portfolio, right? You have you start buying in 2016. I can only imagine, right? So you're leaving money on the table.
Just to be clear, I don't have as much as people think I have, but I have a lot.
So yeah, not Stephen Mark Ryan, but
well, I don't know how much he has actually.
He puts out videos explaining it, but anyway, the point is you're leaving money on the table. And so if you're going to tell me that you could take and collect, even if it's $100 per week, right? And what you're saying, if we open up the put chain right now and take a look at it, that means you're committing to something like a 600 or a 500. It's really, really low. And so why not?
What's really low?
The risk is really low and the premium is also really low. Right. So $100 isn't that much, right? At $10, oh sorry, $1 per share means you're collecting $100, right? And so we could look at that. And one other thing.
Well, let's talk about a sample transaction I could do, right? I could take 100 of my shares of Tesla, right? And I could, let's say, sell a call. I'm more comfortable with selling calls than selling puts. Okay. So I sell a call where I'm agreeing to sell my Tesla shares at $1,500 a share next week. And I don't make very much money on this call because the probability of it going over $1,500 is small. So nobody's willing to pay me a lot for that option, right?
Exactly.
So I might make $10.
There you go.
I might sell the call for $10. But if something happens, if all of a sudden Giga Texas and Giga Berlin start producing vehicles more than we expect, and FSD version 11 is released and it's amazing, and the Tesla bot prototype is the Tesla announces that Cybertruck's actually getting delivered in Q3, right? A bunch of really good bits of news happens.
Sure.
And the stock surges to $200 a share. Now I have to sell 100 shares.
2,000 a share.
To 2,000. What did I say?
200, but that's okay.
Right. The stock goes to $2,000 a share. Now I have to sell that 100 shares of stock at $1,500 a share.
Exactly.
So that's $150,000 in Tesla stock
that you're going to collect.
which would have been worth $200,000 if I held it, but I had to
Sure.
sell it at 1,500. So
Right.
I'm losing $50,000 by not capturing the gain that happened when the stock rose. And look, I get a small payment for selling the call,
Yes, but
and I have a very small risk of losing a very large amount of money in
right.
not capturing the additional gain from the stock going above $1,500 a share.
Sure. Fair,
Right.
fair point.
And
Risk reward, right?
and I think one of the things I'm just going to suggest this. There's there's these. I think they won the Nobel Prize in economics for this. Is Amos Tversky and Daniel Kahneman. It's known as Kahneman-Tversky prospect theory. Humans are not very good at comprehending small probabilities and also large probabilities. So if the probability of something that happens is really, really small, we're not good at evaluating. In other words, if you have a 50-50 type of thing, we're pretty good at evaluating 50-50 risks. You know, if you're betting on a football game, who's going to win the football game? It's not like somebody has a 99.99% chance of winning the game and somebody has a 0.01% chance of winning the game. It's usually like 60-40, 75-25. They usually, you know, you have a really strong team and a really weak team, it might be more, but it's still, you don't get to those insane odds. But when you start dealing with issues like this, you can end up with some very small probability events that have very high costs, and humans aren't very good at that. And you also have very large probability events, like it's very likely the stock is going to be here. We're just not good at that. So if anybody's interested in that you can just Google prospect theory, find it on Wikipedia. Kahneman and Tversky, brilliant stuff. And these are sort of the problems that I feel like people who want to get into options don't see. Is what if there's a small probability this event happens? Are you really good at evaluating that small probability and then comparing that small probability to what the cost is going to be to you if the small probability event happens?
Right. But the example that you're giving is a very small probability. There would be multiple zeros, you know.
Well, all right, let's try this. If I said to you, there's a 0.5% chance that
Okay.
Tesla's going to reach $2,000 next week.
That's impossible.
Why is it impossible?
Because you're talking about a $1 trillion.
I'm sorry.
Entering.
For me to lose money, for me to lose money, okay, the stock only has to go to $1,600 a share. If I'm selling a $1,500 call, right?
You're not really losing money.
Well, I'm losing the $100 in extra share price.
Yeah.
On 100 shares, which is $10,000. I'm losing
Sure.
You can try to couch it however you want. I'm losing the $10,000 that I would have gained if I held the stock.
Of course.
Okay. So I'm taking $100. Let's say I'm getting paid $10 for the option, but I'm risking losing $10,000. If the probability of this happening is greater than 1/10%, then I'm actually losing money in expectation. But it's really hard for you and I to wrap our heads around what's the probability that the stock is going to go to 1,600 next week. We have trouble perceiving these things.
Sure. But the point is, the probability of that actually occurring is something that I'm willing to say, you know what, that is such a small probability that, you know what, I'll gladly sell my shares at 1,500 next week and wait for it to maybe come back down, because that's some serious FOMO, right? Fear of missing out that's occurring. So, you know, it's a game of probabilities in that where are you willing to sell? Because in my mind, the chances of 1,500 next week is impossible.
Well,
it's literally zero in my mind.
How do you measure that probability though?
This is in my mind, right? I say that it's 0% chance, and I'm willing to sell you a contract. And if I'm wrong, the worst case that happens is I'm really happy because my stock just ran 50% from 1,000 or whatnot in a week, and I'm still getting a lot of money.
But I mean, Tesla stock went as low as $700 not that long ago, and now it's trading over 1,000, which is roughly a 50% gain. And we can't know that they had a pretty big run in 2020.
Right.
I figure this 2020 or 2021, there was this massive run up in the stock for a stretch of time. And it seems crazy that a stock could go up. And just to be clear, the reason why I think it's not a low probability event, I'm not saying it's a high probability event, right? But I think it's a better than 1% chance that the stock reaches 1,500 next week. And the reason that I think that is because underlying this is my view of Tesla as a company, right? I believe that Tesla stock today is worth $2,500 to $5,000 a share. Because if I'm looking 8 years down the road at 2030, and I think the stock is going to be worth more than $10,000 a share, as a long-term investor rather than an options trader, right? What would I be willing to pay today for something that's going to be worth $10,000 in 8 years? I would probably pay significantly more than $2,500 for something that's going to 4x in 8 years.
Right.
Right. For something that's going to do that. So my take on it is it's the probability that enough of the market starts to realize Tesla's true value.
Right. And that's what's
and there's a
happening.
significant chance it won't happen, right? Because it seems to me that it's taken the market an awful long time to catch up. But the stories that are told to say Tesla's not going to be successful, that isn't going to grow like that, are pretty weak stories. I just did a video on my channel about Toyota and what Toyota's doing, because one of the things that we always hear about Tesla, why Tesla's not going to succeed, is the competition is coming. Right.
Yeah.
And I'll say, well, wait till the big boys come, wait till Toyota comes or Volkswagen comes or GM or Ford. When they turn their guns on Tesla, it's over. And like, well, Toyota's strategy is roughly 3 years from now, they're going to start testing what they hope will be a solid state battery in a hybrid they probably won't really be selling yet. And maybe 5 years from now, they're hoping to start selling vehicles with solid state batteries in, and they're hoping that the solid state batteries will cost less than the existing lithium ion technology that Tesla is rapidly improving and CATL is rapidly improving. To me, it's obvious that Tesla stock is massively underpriced.
Yeah.
And I haven't seen a very sound model yet from anyone who's really looking at the business to say the stock, isn't going to go to 1,500, isn't going to go to 2,000. It's always like, well, they don't see the margins, they don't see the profits, they don't see the growth. They massively underestimate Tesla's growth. They consistently underestimate Tesla's growth. They consistently underestimate Tesla's profits. And it could just be something as simple as, I don't know if this is within that week we're talking about, but April 2nd, we get delivery numbers. What if their delivery numbers are 20,000 higher than Troy Tesla's estimate, right? Because Troy is usually reasonably conservative. He estimates higher than Wall Street, but he's usually more conservative than a lot of us. What if the earnings now this is too late for this options trade we're talking about, but suppose April 27th, I'm going to guess, or April 25th or something like that, we get the earnings.
Right. End of April.
All of a sudden, gross margins shoot up, right? The margins on vehicles shoot up because they've been raising prices and they've been pulling forward. I think they've been pulling forward FSD purchases. No, but I think margins suppose margins hit 35%, right? Because they've been pulling FSD forward and they raised prices. And I don't think it happens Q2, by the way. I think it happened Q1. I think it happens Q2. But I'm just saying events can happen that can, suddenly shift market perceptions.
Right.
And then the, Ukraine and Russia sign a peace treaty and all the concerns about all that go away. And, a lot of different exogenous things can happen that can, radically change the price in a short time.
Yeah. This is why I like the put side, because you're selling a contract to, either a short seller, or you're selling a contract to a person that's looking for insurance. So that's why, I prefer the put side, because I think the Tesla is going to run, and I'm just selling contracts behind it,
But even on the put side, you sell a put with a strike price of $800 a share, and then Elon Musk gets sick and he's hospitalized.
Yeah. Right.
And he can't run the company. So you sell a put, Elon gets hospitalized. One of the things I hate about Wall Street, the way Wall Street and the media talk about Tesla, is anything Elon does is like, oh no, Tesla's in trouble because Elon did this. And then if Elon was hospitalized, they'd say, oh no, Tesla's in trouble because Elon's not available to the company. Something like that could trigger a massive sell-off in the stock. And now all of a sudden you've got to buy Tesla stock at $800 a share, and maybe it plummets to 500 and never comes back.
Right, but again, this is risk reward, and is Tesla that reliant on Elon at this point? Right.
You and I both believe that Tesla will succeed without Elon.
Correct.
But market perceptions can last a long time.
But it's temporary, right? So
it could go 2 years easy.
But at the end of the day, I'm a fundamental type of investor. I'm analyzing the underlying business. I'm not investing in Elon, right? Although I respect him and look up to him in certain ways. You'll see him behind me there, telling the world, I don't care about my stock price, right? It's all about cars. And again, it's the same on this side as it is on the call side. What risk are you willing to take on? In my mind, I'll happily pick up shares at 700 or 800 or whatever it is, because I believe in the long-term growth of Tesla.
Right, but here's the point. Elon is a 51-year-old man. I'm a 56-year-old man, so I'm very sensitive to this. If you look at actuarial tables, you look at other things, there's roughly a 1% chance in a given year that something bad happens to a 50-year-old man, that he has a heart attack, that, and I'm not saying dies, but something happens that disables him and makes it difficult. And markets react.
Absolutely.
Or Elon decides, you know what? I think Tesla's in good hands with Drew and Zach and the team. I'm going to shift all my time into SpaceX. I'm walking away from my CEO role at Tesla. There's all kinds of small probability events. I don't think either of these things are going to happen, keep in mind, but there's small probability events. And the cost side of, if a small probability event happens and you have to buy Tesla stock at 800 when it falls to 500.
Again, but this is the point, is that it's a matter of what risk are you willing to take on. And if that never occurs, well, that's, you left a bunch of money on the table. If it does occur, well, okay, you were right. But
also
we just went through that.
But also you have to fully evaluate the risk. And a lot of people have trouble evaluating what's the probability of this kind of event, how many bad events could, and then here's the thing, when you have like some small probability event could happen and you worry about that one small probability event and it's a small probability, but there's 1,000 small probability events that could happen. That could create problems, and 1,000 times small probability all of a sudden becomes a not quite so small probability.
But that might not be enough of a reason for you not to act, right? And in my mind, we just went through I purchased shares at 1,100, I purchased shares at 1,000, 950, and I kept buying the dip, right? Okay. And we went down all the way down to 700. Did people load up, right?
Yeah, I bought it around 1,000 a while back. And it fell to 700. And I bought more. I happened to have some free cash free up when it was in the 700s, and I picked up another bunch at 741. And I have not felt bad at all about the $1,000 share price that I paid, just because I'm long term. I'm holding for another 8-10 years, whatever, maybe longer. So I don't really care about the momentary ups and downs, and I'm not playing the day trading options game, so I just don't worry about that stuff.
But that's the thing, is so like my core position is long term, and a dollar cost averaging, just picking it up as money comes in, is a great strategy. But then there's this trading around the edges, right? If you could take $500 and multiply that by 52 weeks, obviously there's sometime you'll lose, but let's say you're averaging about that much on the put side.
$25,000 a year.
Right. And so do you want to just leave that on the table? I don't. And that's being more conservative. Now, there are times where you're not getting $500. Tesla's running like this, and you're scooping up $2,000 or whatever it is that you're able to do. So you have to examine that across the entire year. And but you can't do any of that if you don't educate yourself on how that works.
So I think we should wrap this up, because you've got some personal stuff to deal with and maybe business stuff to deal with, and I probably should get to my life. So let me just ask you really quick, is there anything else? I want to let you close this out. I'm going to say something at the very end, but I want to give you a chance to close out with just sort of your general thoughts on trading options, what you're doing, how you feel about what you're doing, and what it's doing for you.
Thank you, Warren. I feel that I became empowered by educating myself, but by watching YouTube videos. That seems insane, that a person can spend some time, however much time you're willing to devote to it, and it has changed the trajectory of my life. That's a pretty big statement to say, right? To go and sell your house because you want to raise enough cash, you believe so strongly in something like Tesla, and to put it all in there. Well, that's a lot of people that perhaps they didn't put all of their eggs in one basket, but they have a sizable portfolio. And learning this has changed the cash flow that comes in, right? Being able to bring in an extra, $500 or whatever it is, means that you can, especially if you have more shares, you can sell more contracts, which means you can upgrade your life. Right now, there's downsides to it, which is if you're wrong, you can get yourself into a pickle. But it doesn't mean that for me, it's been a bad idea. It's been very good, but I think it is important to analyze all of those risks and evaluate whether it's a good thing for you.
Okay. So, Xander, I want to thank you so much for, do you want to briefly promote your yogurt business?
Sure. Menchie's Frozen Yogurt is the world's biggest frozen yogurt franchise. I'm an employee. I got the job from Craigslist, and then worked my way up to becoming an owner, and now I'm a multi-unit operator. So,
Where are your locations?
I'm in Southern California, so I have a couple in Santa Clarita Valley, and actually the original location in Valley Village, California, and Burbank is the other location.
And you eat the product as well?
A little too much.
Okay. All right. My
kids love it.
I was gonna say my kids would love that. Really quick, please check out my other videos. Please support this channel on the Locals platform, Patreon or YouTube channel. Links to all that in the description below. Check out the t-shirts. The chicks like the insanely gigantic t-shirt. I'm telling you, it's an Elon Musk quote about something else, but chicks dig it. And thank you so much for watching.
Thanks for having me, Warren.